Okay, so one of the big concerns that we're running into is essentially what's going on with the bond market. Now, there's a lot of really crazy titles out there. Let me read to you some of the news article titles because, it can be scary to hear things like this. Here, I'll give you some of them. Returns in the bond market have almost never been worse. They're talking about 150 years. Treasury yields set for the biggest slide since March. And when they say slide, they mean like that. Okay. Wall Street isn't sure it can handle all of Washington's bonds. BlackRock warns the historic U.S. bond market crash is far from over. Carnage in the bond market. How long can the long bond futures fall? So there's a lot of scare in the bond market. And obviously, for Social Security recipients, they're worried about their special bonds. Now, let's go through what a special bond is. Let's get some basics out there. This is straight from the SSA website. All right. So there are basically two types of bonds. Let me see if I have the sheet in here specifically that outlines it. Hold on. Where is it? I don't have it. That's okay. We're just going to read through. We'll just go through this. All right. Bottom line is this. Okay. Trust funds and types of investments, right? The old age and survivors insurance trust fund, so retirement and disability stuff, and the disability insurance trust fund comprise the Social Security trust funds. Okay. Both funds are managed by the Department of Treasury through their Bureau of Fiscal Service. Okay. Since the beginning of the Social Security program, all securities held by the trust funds have been issued by the federal government. There are two general types of such securities. Okay. Remember, a bond is a security. Things like whatever, stocks are a security. So there's these made up things that people make money with, and they're called securities. In this sense, we're worried about two types of securities: the special issue bonds and the public issue bonds. We're really only worried with the first one, the special issue bonds. Special issue bonds are available only to trust funds. Public issued bonds are marketable treasury bonds available to the public. Trust funds now hold only special issues, but they have held public issues in the past. What they're saying is that these special bonds are created by the government, and they're not really accessible to, or they're created by the government. They're not really accessible by the public. They're these special, unique bonds that we put our money into when we pay our FICA taxes. The money sits in there for a little while, then they cash them out. And that growth in money from being in those bonds is what increases the longevity of our trust funds, even though it doesn't increase it enough. Cool. Now we got that. Special issue types. Okay. There are two types of special issue bonds: short-term certificates of indebtedness and long-term bonds. The certificates of indebtedness are issued on a daily basis for the investment of receipts not required to meet current expenditures, and they mature on the next June 30th following the date of issue. So what we're talking about is every June 30th, every year, these certificates of indebtedness go ahead and mature. Okay. They're issued on a daily basis for the investment of receipts not required to meet current expenditures. So they're not needed in a super immediate sense. Then you have the other kind of bonds. The special issue bonds are normally acquired only when special issues of either type mature on June 30th. The bonds generally have maturities ranging from 1 to 15 years. Okay, so these are now much, much longer bonds. Much, much longer bonds. Cool. All right, so you've got the certificates of indebtedness. The investment frequency is daily. They're constantly putting the money into those. Maturity is every June 30th, so every year. Then you have the regular special bonds. Those are basically June 30th. That the investment frequency occurs where we put the money into it, and then generally they exist for 1 to 15 years, so they have more time to grow. Okay. Now, why are we talking about bonds? We're talking about bonds because the bond rates are super shitty right now. Let's go through that real quick, straight from the SSA website. All right. So if we go back to 2000, bond rates weren't doing super duper great. The average for January through basically, or the average for the entire year was 6.240. But, you guys remember 2000 was like, a collapse of the world because bottom line, we were worried about the whole millennia thing where it was switching over. They were also worried about millenniums. Sweet, really? So bottom line is this. It went from, it went to 6.24, then it went down to 5.22, then it went down to 4.86, 4.0, 4.27, 4.3. They were high. We get to around 2008, the collapse happens. We get about a 3.63. We get about a 2.9. And then we get to, here we go, a 2.7, 2.4, 1.4, 1.8. Now, what you need to know about bonds is that they have an inverse relationship to how stocks work. Okay, let me give you a quick little definition here. Okay. Why interest rates affect bonds? This is straight from PIMCO. Bond prices have an inverse relationship with interest rates. This means that when interest rates go up, because our interest rates are really high right now, bond prices go down. And when interest rates go down, bond prices go up. Okay? The reason the price of a bond reflects the value of the income it delivers through its coupon interest payments. If prevailing interest rates, notably rates on government bonds, are falling, older bonds that offer higher interest rates become more valuable. The investor who holds these bonds can charge a premium to sell them in the secondary market. Because remember, some people hold on to bonds to get the money out of the bond. Some people then sell the bonds. Cool. Okay. Alternatively, if prevailing interest rates are increasing, older bonds become less valuable. So, right. So if prevailing interest rates are increasing, like what we have right now, older bonds people bought back in the day, become less valuable. People aren't trading them on the secondary market because their coupon payments are now lower than those of new bonds being offered in the market because new bonds are a better deal. Cool. You guys got that now. Okay. Now, what does this mean with what's going on with the bond market? What's going on with this whole situation? Okay. So you have Wall Street. You have the journal, Wall Street Journal, coming out with a bunch of articles on it. The problem we're facing is that normally Wall Street will purchase a certain amount of bonds. But now what they're finding is that those in Wall Street are not so super duper excited about buying US bonds. Because let's just be honest, we've got a major problem. We're 33 trillion in debt. Our international currency is not being used as much as it would normally be used. And then on top of that, like 20 countries have said that are major countries that they're not going to use our currency in the future to buy stuff. That's a big problem. They know the US is about to face a quasi collapse when it comes to financial security. That's why they lowered the bond rating rate for the US. That's why the US doesn't look like a really good option in the future. Okay, cool. All right. So let's go through this real quick. Article from the Wall Street Journal by Eric Wallerstein. Ever since the Federal Reserve broke the inflation scare of the 1980s, Wall Street and Washington have shrugged off multi-trillion-dollar deficits, counting on America's global standing to provide perpetual demand for its debt that could finance the spending for now. The steep declines in prices of treasuries meant to be the world's safest and easiest trade investment. That's an important sentence there. What that sentence is saying is that we rely on bonds for parking money when we don't know where else to put it. You could put it in stocks, but they're riskier. You could put it into investing in a company, but it's riskier. You could put it into investing in a new product, super risky. But the safest has always been bonds. That's where you park your money and you know you're going to get your money with more money at the end of the day. Not a lot more money, but you're going to get your money at the end of the day. It's the safest option. Okay. All right. So what's happening is these bonds are, so meant to be the world's safest and easiest trade investment. These treasuries are forcing markets to confront the possibility that the rates required to place all this debt will be higher than anyone expected. The yield on the benchmark 10-year Treasury note, which rises when bond prices fall, briefly surged near 4.9% on Friday after the monthly jobs report showed U.S. employers hired nearly double the workers that economists were anticipating. The strength of the labor market is one reason bond yields have soared this year, reflecting an improved outlook for economic growth and inflation. Because, when they see a lot of people getting hired, they think a lot of people are working. Looks good. Cool. Looks good. Okay. Now, with this said, U.S. Treasury Net issued a report. And then they came out with another report this summer after the Treasury Department caught Wall Street off guard by announcing it would borrow roughly $1 trillion in the year's third quarter, more than $250 billion above previous expectations. Already more than 1.76 trillion of the treasuries has been issued on a net basis through September, higher than in any full year in the past decade, excluding the 2020's pandemic surge. Official estimates show that it is unlikely to decrease. So what's happening is the U.S. is saying, we want you, Wall Street people, to buy a lot of bonds. We're going to issue a lot of bonds here because we want you to buy them. We want you to invest in America. You remember, we go back to World War II. U.S. bonds is a bullet, for your best guy in the field to fight, basically evil people in World War II. Same kind of gig. You're investing into the United States. Well, what they're saying is, we're scared as a country, the U.S. We want this much money to secure ourselves, and we want you, Wall Street, to basically put your money and park it in us because we want the money to play with. And Wall Street is saying, but we don't know how secure your bonds are going to actually be. So what's happening is there's this issue where if we look at essentially where the whole bond market situation is going, all right, let's look at the rates over here. So 2019 bond rate was 2.21, 2020 0.9, 2021 1.39, 2022 2.958, 2023 is going to be somewhere around 4. So the bond prices or the bond rates are going up, which means the bond market is going to go down, which means investing into bonds right now, it's a bad idea. You just shouldn't do it. Now, why is this all relevant to Social Security, trust funds, and bonds, etc.? When the government comes out and says, we want you to buy more bonds than we've ever issued before, we want this much money for how many bonds we're willing to put out there. It's saying something to the average basic person who wants to go ahead and park their money. The U.S. is saying, we will give you the opportunity to have us park your money with us, and we'll make you money, and we want all of your money, all of it, and we're going to park it in these bonds, and you should be happy for that. But all the economic individuals are looking at this and saying, wait a minute, why are they asking for so many bonds to be issued? Why do they want so much from us? So the problem that we're facing is, okay, there is a shelving problem that is occurring with the bond market. So when things go down, they either go down like this or they do this, right? So if you go ahead and look up basically the bond market and what it's doing right now, you will see that there are shelves. It literally dives and then does this thing. And then it dives and does this thing, which is why they're calling it like the bond market apocalypse. What my fear is ultimately what will happen to the Social Security Special Trust Fund bonds, because they're not directly injured by essentially, what's happening with the bond market, of what the market is doing in the sense of people being able to buy bonds, but they are injured in how people react to bonds. And the less likely people are to buy into bonds, the more of a struggle the special bonds that uphold our trust funds, our retirement, our disability trust funds, the more difficult the situation becomes for that money to go ahead and grow and be worth more in the future to fund our trust funds. So I'm trying to figure out a way to put this the best way possible. My concern is that our special trust fund bonds are not going to do as well in the future, which will decrease the longevity of how long that money in those trust funds will actually last. So instead of, for example, it taking 10 years for retirement to run out, it might take 7 or 8 years because of some trust fund bond issues that occur, where the market does not go ahead and improve, and then people view the US dollar as a negative, and the bond market keeps going down. It's a problem. So what happens is that ultimately we have to want our economy to do very well. And we have to want basically these interest rates to come back down. When interest rates go up, our bond markets are bad. Now, there's another thing. If interest rates go up for a long time, it can be good for the bonds. But if interest rates go up for a short period, it's bad for the bonds. And what I'm thinking is the interest rates are realistically going to be up for, 3-4 years, and then they'll come down, which is bad for our bond market. Now, you might be saying, hey, whatever, it'll equal out in the end, but it's not going to. It's not going to, because people don't invest in American dollars and American bonds like they used to. So the problem is, if we're not going to see people wanting to invest into American bonds like they did back in the day, then what happens to our bond market? Well, people aren't spending as much into they're not buying as many. They're not going ahead and, getting as good of a rating. They maybe don't get as much of a return, yada, yada, yada. There's not as much secondary trading on the open market. But what's happening is we're starting to see the erosion of the seawall of the Social Security trust funds and the base currencies, the base securities that they rely on to go ahead and fund our Social Security retirement benefits going forward. The Disability Trust Fund isn't in terrible, terrible shape. It's not in great shape, but it's not in terrible shape. The Retirement Trust Fund is in terrible, terrible shape. The Medicare Trust Fund is in horrible shape. Okay. So the point of this video is to explain to you the bonds that we use to fund Social Security trust funds going into the future are not likely to be something we want to use 15 years down the line, 20 years down the line to pay for all this stuff, because their capacity to have a good ROI, return on investment, we pay our FICA taxes, they put them into the trust funds, they put them into the trust funds, they convert them into special bonds, they pay them back out to the trust funds. Those special bonds in 10 years, or even less actually, are not going to be what we should invest our money into in the future, because they're just not going to have the same power as the strong America did all the way up until basically the past couple of years. Okay. So just keep that in mind. That's something to consider. All right. You guys have a wonderful night. I hope I didn't make it too confusing. I'm not good at explaining the economics of this, but I tried. Anyways, it's kind of late. I got to go to the post office, but let me read some of the comments real quick here. Net Detective said, okay, so SSI is ending in 10 years? No. SSI is paid from general taxes, which means that SSI will technically never run out. How can that be? Yeah, SSI isn't going to run out. Okay, Slathering said, who said that? It's the trust funds that are in danger. Yeah, so the trust funds are in danger. That's the main problem here. We want bonds to be strong. We want our special trust fund bonds to be even stronger. But the problem is they're seeing a collapse in our bond system as to how we use them. And that's just a reshelving, right? We started here. We got a new shelf. We got a new shelf. We got a new shelf. Instead of one of these graphs, it's one of these, right? That's what we're seeing. Okay. Okay, so Net Detective said, but he's been saying SSI is running. SSI is never going to run out. Supplemental security income will never run out. It's paid for by general taxes. When retirement benefits, Medicare benefits, and SSDI benefits run out, SSI benefits will still be chug-a-lugging that train down the line. So those will always be around. Okay. Wow, Pitbull Winkle, you think the gold is going to back it again? There's no way we could return to it. We have like silly money numbers. Like there's not enough gold literally on this earth to handle all the trillions and gajillions that we would need to back it by the gold standard. We're never going back to that. It's just not possible. Okay. Ronnie Martin said, could SSA stop in a world war? Yeah, I mean, anything can happen in a world war. There's nuclear bombs, there's all that kind of stuff. But is it likely to stop? No. The SSA, out of all the agencies, is actually the most likely agency to continue working, even if there's a government shutdown, even if there's a problem. And here's why. There's a special rule that was created that basically allows the SSA, if it can't get funding from its usual sources, to take money from the trust funds and pay itself to continue to operate to pay out the benefits that are needed. Will that wipe out the trust funds very quickly? Yeah, it will. But it will still keep running until basically they run out. Okay. Anyways, guys, I will catch you a little bit later. You have a wonderful, wonderful, wonderful night. Please sleep well. Please remember to like. Please remember to subscribe. If you want to leave a review, Disability Resolution Florida on Google or Disability Resolution Law Firm. I will catch you guys later. Have a wonderful night, and we'll go from there. Thanks so much. Bye-bye. Bye-bye.